Hey everyone, it's Jonathan. I want to make a completely free video just because there's a really unique opportunity presenting in the bond market. And from what I've seen, most people trade bonds wrong. So watch. In front of you, this is the yield curve. Okay? Right now the Fed's moving, right? The Fed's in play. As rates go higher, prices go lower. But rather than speculate on the direction of bonds or notes, the proper way to trade bonds is relative value. And let me explain exactly what that means. Here are the liquid contracts from the Chicago Mercantile Exchange. You got the 2-year, the 5-year, the 10-year, the 30-year, the bonds. Now, a lot of people just trade ZB or TLT, but you can't trade any of these in isolation. Here's why. Whenever we analyze bonds, we need to do it relative to one another, okay? Because what happens is these contracts are all driven by supply and demand, right? So all of a sudden, if China needs to sell a whole bunch of 5-year future contracts, 5-year futures are going to get inexpensive relative to its neighbors. So as rates go higher, if you think bonds are going lower, if this happens, you don't want to sell the 5-year, you want to sell the 10-year. Or maybe the 10-year gets really expensive. When this happens, if you want to sell a futures contract, you want to do the 10-year. If you want to buy a futures contract, you absolutely do not want to do the 10-year. Same thing in the bonds. You get the picture. Now, I wanted to do this free video right now because there's a really, really great trade setting up, and I want to share it with everyone. So now watch. Here is the ZB against the ZN and against the UB. This is called the bond butterfly. What I'm doing is looking at the value of the bond relative to its neighbors. And you can see the bond is dirt cheap relative to the 10-year, relative to the ultra. Now on this side, I have the 10-year relative to the 5-year, relative to the bonds. The 10-year is very expensive relative to its neighbors. The bond is very inexpensive. Here's how to use this information. So remember, 10-year is expensive, bond is inexpensive. So for outright traders, those trying to take advantage of rates going higher and bonds going lower, don't sell the ZB, wrong contract. Don't sell the TLT, wrong contract. If you're looking to get short, if you think that prices are going to go down, you want to sell the 10-year. That's the right contract, and you can see the butterflies coming off, but watch what happens when we go to the outright. 10-year. That's what we want to sell. If you're looking to get short bond contracts, the correct contract to sell is definitively the 10-year. That's where you're going to get the best return, not the 5-year and not the bond. And then it's all about managing money. If I open it up on a longer term chart, we know we want to sell the 10-year. That's the right contract. Now the game is, let's find a good entry point. Daily, going back to the beginning of 2016, 200 period moving average, 100 period moving average. What about any kind of outright sales with stops above the moving average? That seems like a pretty good entry point. For one, we know we're in the right contract because 10-year is definitively more expensive than its neighbors. That's how we trade bonds. That's how we drill into the right trade. Now, if I look over at the ZB, even if you're convinced that it's going down, even if you want to do the same trade, don't do it with the ZB. Do it with the ZN, the 10-year. That's where you're going to get the most bang for your buck. Okay? Free video, guys. If you like the video, it's absolutely my pleasure. The only thing that I ask from you, add a comment. Let me know. Give it a share. Okay? This is a really great setup. I personally love getting short ZN right here, managing money, patiently waiting for it to roll over and come back down. Okay? Thanks, guys. Jonathan Rose, active day trader.